Welcome back to the Wall Street Podcast. Today we're diving into the China beverages sector, specifically looking at the latest research from Goldman Sachs Asia. That note came out September 27th, 2025.
Right. And it takes a, let's say, more selective stance on the sector. They really zeroed in on three critical pressure points: rising competition from freshly made drinks, FMDs, shifting market share in packaged water, and, how long these cost benefits might last.
Okay.
Our goal here is to really distill the immediate investment implications for you.
All right, let's unpack this then. The pressure from FMD competition, it seems to have really ramped up into Q3. It's hitting the ready-to-drink, the RPD names, harder than maybe expected. Where's the main vulnerability?
Well, the impact is definitely most pronounced on UPC and Tingy. You saw UPC's beverage sales actually turn year-over-year negative in July, August.
Ouch.
Yeah. And the vulnerability, it really stems from their high exposure to milk tea and the traditional tea segments. That's where the pricing gap with mass market, often subsidized FMDs has really narrowed.
Okay, so a tough headwind there. But conversely, we are seeing some cost tailwinds, right?
Yeah.
How long is this packaging material deflation expected to support margins?
We're forecasting about 3% to 6% unit cost deflation for the full year 2025. That's mostly coming from PT and sugar price benefits. And even with some normalization expected in the second half compared to the first, the sector could still see, up to maybe 1.8 percentage points of gross profit margin expansion. That provides some pretty decent visibility for margin protection, even with the intense competition.
Right, the GPM cushion is key. So thinking about that FMD headwind, what are the key defensive plays? Which companies are holding up better?
Nongfu and Eastroc are definitely noted for their resilience here. Eastroc, which is now on the APAC conviction list, really benefits from its focus on functional drinks. They serve pretty distinct customer groups, kind of insulated from that direct FMD squeeze.
I see. And Nongfu.
Well, Nongfu's sugar-free tea segment, it continued strong double-digit growth in July and August. That just reflects its health-oriented, differentiated profile. And, this is why Nongfu's 2025 to 27 earnings were actually revised up slightly by 0.2% to 1.7%, while UPC and Tingy saw reductions.
Okay, that makes sense. Now, here's where it gets really interesting, I think. The Wahaha brand dispute. Historically, what tends to happen when major beverage brands get into these kinds of trademark conflicts?
Yeah, that's a crucial point. If you look at past disputes like Red Bull back in 2016-17 or JDB versus Wong Lo Cat around the same time,
Right.
they often resulted in pretty long-lasting negative sales impacts and, importantly, significant market share shifts. So for Wahaha, their bottled water point-of-sale coverage rose to over 75% recently, which is quite high. But any potential changes forced on the brand name, maybe to something like Wahaha, that really offers Nongfu a clear path for picking up share.
So let's quantify that. What does, say, a 1 percentage point share gain actually mean for Nongfu in this scenario?
Under the current dynamics, our model estimates that each 1 pp'd water volume share gain translates to roughly RMB 1 billion in incremental sales.
Wow.
And about RMB 0.3 billion in incremental net profit for Nongfu just for 2025. And you can see Nongfu is already actively facilitating this. They're using agile channel policies like RMB 1 to 3 promotions per case to encourage that shift.
That's quite proactive.
Yeah.
Okay, shifting to the bottom line then. Beyond these top-line pressures and potential share gains, what's the crucial earnings expectation for the second half of 2025 for the key players?
We're currently expecting pretty robust 2H25 earnings growth for Nongfu. That's around 29% year over year, and also for Eastroc at 35% year over year.
Strong numbers.
Very. However, CR Beverage is anticipated to see a pretty steep earnings decline, maybe 49% in the second half. That's largely due to their ongoing channel reform and, frankly, higher marketing investments needed to stay in the game.
A real divergence there. So we've talked strategy, market share, earnings.
Yeah.
What does all this turbulence actually mean for the consumer, for everyday life?
Well, for the public, this intensified competition actually translates directly into more value. You're seeing it already: more promotions, increased value offerings, lots of those large pack SKUs in RTD drinks appearing on shelves.
Right.
Consumers are, in the short term at least, benefiting from that narrowing price gap between convenient bottled drinks and those subsidized FMD options.
Interesting. So it really raises a question for us to leave you with. Given this historical resilience we've seen in health focus and functional categories during market disruptions, is the market now permanently re-rating players like Eastroc and Nongfu, basically valuing that portfolio distinction perhaps more than traditional scale in tea and milk tea? Something to consider.